Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and joining me today are Lizzie and Steve to break down what's happening in the markets this Thursday, January 29th. We've got some fascinating developments to discuss today, particularly in the commodities space where gold is absolutely on fire, and we're seeing some interesting divergences in the tech sector. Lizzie, let's start with what's really catching everyone's attention. Gold just blew past $5,600 an ounce for the first time ever, and it seems like it's stealing all the thunder from other assets right now.
Robert, this gold rally is absolutely remarkable, and what's really interesting is the speed of it. Goldman Sachs just set a target last week, and gold has already blown right through it. Now, JP Morgan analysts are plotting a path to $8,500, which sounds crazy, but given this momentum, who knows? What we're seeing here is classic safe haven demand. Investors are clearly concerned about economic uncertainty, and they're piling into gold as a hedge. The really fascinating part is how this is affecting other markets, particularly crypto. Bitcoin is struggling to break above $90,000 and keeps getting rejected at that level, and I think a lot of that has to do with capital flowing into gold instead. When you have gold adding nearly Bitcoin's entire market cap in a single day, that's a massive shift in where investors are putting their money. The other big story is the divergence we're seeing in tech. Meta is surging because Wall Street is giving Zuckerberg the green light to keep pouring money into AI investments, while Microsoft is slumping. This tells us that investors are being very selective about which AI plays they want to be in. They're rewarding companies with clear AI strategies and punishing those where the returns aren't as obvious yet.
That's a great point about the selectivity in tech, and I think it really underscores how mature this AI investment cycle is becoming. Investors aren't just throwing money at anything with AI in the headline anymore. They want to see concrete plans and returns. The other sector that's really interesting is travel and leisure. Royal Caribbean is jumping on accelerating demand and fleet expansion plans, which suggests the post-pandemic recovery in that space still has legs. Steve, let's turn to the economic data. We had some important releases earlier this week, and we've got more coming. What's the picture looking like?
Thanks, Robert. So, looking at what we've seen earlier this week, the Federal Reserve held its policy meeting on Wednesday and kept the federal funds rate steady at 3.75%, exactly as the market expected. So, no surprises there. The Fed is clearly in a holding pattern right now, waiting to see more data before making any moves. Earlier in the week on Monday, we got durable goods orders for December, and this was actually a pleasant surprise. The headline number came in at 5.3% month over month, which beat the forecast of 3.7% and was well above the previous reading of 2.1%. This suggests that manufacturing demand is holding up better than expected, which is a positive sign for the economy. Now, looking at today, Thursday, we don't have any major economic indicators scheduled for release, so it's a quiet day on the data front. But tomorrow, Friday, is a different story. We're getting the Producer Price Index, the PPI, which is a key inflation indicator. The market is expecting a reading of 0.2% month over month, which would match the previous month's reading. This is going to be important because it'll give us insight into whether inflationary pressures are building at the producer level, which eventually filters down to consumers. With the Fed on hold and watching the data closely, any surprise in either direction could move markets.
Thanks, Steve. That PPI number tomorrow will definitely be one to watch, especially with the Fed being so data-dependent right now. All right, Lizzie, let's shift gears and talk about some value opportunities in the stock market. We've analysed hundreds of stocks looking for those classic value investing characteristics: low price-to-earnings ratios, strong return on equity, good dividend yields. What are the top 3 value stocks that are standing out right now?
Robert, I'm really excited about these 3 names because they're showing all the hallmarks of being undervalued by the market right now. Let's start with Universal Health Services, ticker UHS, which is my top pick with a value score of 90 out of 100. This is a healthcare services company, and the numbers are just compelling. We're looking at a price-to-earnings ratio of only 9.66, which is incredibly cheap, especially for a company in the healthcare sector. The forward PE is even better at 8.68. suggesting analysts expect earnings to grow. The price-to-book ratio is 1.77, which is reasonable. And here's the kicker. The return on equity is over 20% at 20.03%, which shows management is doing an excellent job generating returns for shareholders. Now, the dividend yield is showing as 39%, which seems unusually high and might warrant some investigation into whether there was a special dividend or data anomaly. But even if we're conservative about that, the PEG ratio of 0.18 is outstanding. A PEG ratio under 1 suggests a stock is undervalued relative to its growth rate, and 0.18 is exceptional. The company has a profit margin of 8% and a debt-to-equity ratio of 70, which is manageable. What I like about UHS is that healthcare services tend to be recession-resistant. People need medical care regardless of economic conditions. And with an aging population, demand should remain strong.
Those metrics on UHS are really impressive, especially that ROE above 20% combined with such a low PE ratio. It does seem like the market is overlooking this one. What's your second pick?
My number 2 is Edison International, ticker EIX, with a value score of 85 out of 100. This is a utility company, so we're in a completely different sector here, which is great for diversification. The PE ratio is even lower than UHS at 8.16, and the forward PE is 10.11. The price to book is 1.54, which is very reasonable for a utility. Return on equity is 15.77%, which is solid, and again we're seeing an unusually high dividend yield, showing as 564%, which definitely needs verification, but suggests strong dividend payments. The PEG ratio is excellent at 0.13, and the profit margin is strong at 16.32%. Now, the debt-to-equity ratio is higher at 204, but that's actually pretty typical for utilities because they're capital-intensive businesses that finance a lot of infrastructure through debt. What makes EIX attractive is the stability of the utility business model. They have regulated rates and predictable cash flows. With the transition to renewable energy and electric vehicles increasing electricity demand, utilities like Edison are positioned to benefit from long-term secular trends. The combination of that low valuation, strong profitability metrics, and the defensive nature of the business makes this a compelling value play.
Utilities are definitely interesting right now, especially with all the power demand from AI data centers and electric vehicle charging. What's the third stock on your list?
Number 3 is Synchrony Financial, ticker SYF, also with a value score of 85. This is a consumer finance company, and the valuation metrics are remarkable. We've got a PE ratio of just 7.91 and a forward PE of 7.04, so the market is pricing this very cheaply. The price to book is 1.64, and the return on equity is excellent at 21.3%, which shows they're very efficient at generating profits from their equity base. The dividend yield is showing as 163%, and again that warrants verification. But the company clearly returns capital to shareholders. The PEG ratio is 1.04, which is right at that threshold of one that we like to see. What really stands out is the profit margin of 36.41%, which is exceptional and shows strong pricing power and operational efficiency. Now, consumer finance can be cyclical and sensitive to economic conditions, so there's more risk here than with a utility or healthcare company. If we hit a recession and consumers start defaulting on credit, that would hurt Synchrony. But at these valuations, a lot of that risk seems priced in already. The key is that management has shown they can maintain profitability, even in challenging environments. And with that ROE above 21% and such a low PE, I think the risk-reward is favourable for long-term value investors.
These are 3 really solid value picks across different sectors: healthcare, utilities, and financial services, which gives investors some nice diversification. Before we wrap up, Lizzie, let's touch on crypto briefly. What's the sentiment looking like for Bitcoin, Ethereum, and Solana heading into next week?
The crypto market is definitely in a cautious phase right now, Robert. Bitcoin keeps getting rejected at that $90,000 resistance level, and with gold rallying so hard, it's pulling focus and capital away from crypto. More than half of Bitcoin investors are actually underwater now, as the $88,000 support level failed to hold. So sentiment is bearish to neutral in the near term. On the institutional side, we are seeing some positive developments. Sygnum Bank raised over 750 Bitcoin for a market-neutral fund, and Metaplanet is raising $137 million to buy more Bitcoin and pay down debt. So there's still institutional appetite, but retail investors seem more cautious. Ethereum is in a similar boat, struggling to hold above $3,000, though we are seeing exchange supply shrink as staking activity increases, which is generally bullish longer term. The Mega ETH mainnet is launching February 9th, promising 35,000 transactions per second, which could be a positive catalyst if successful. Solana is probably the most concerning of the 3. The validator count dropped 68% due to rising node costs, which raises questions about decentralization and network health. The outlook for next week is neutral to bearish across the board. Investors should watch for Bitcoin to either break above 90,000 convincingly or potentially test lower support levels, and keep an eye on those macro factors like the dollar and gold that are influencing flows right now.
Great overview of the crypto landscape, Lizzie. So to wrap up today's show, We've covered gold's historic rally past $5,600, the divergence in tech with Meta surging on AI investments, while Microsoft slumps. A quiet day today for economic data, but PPI coming tomorrow, 3 excellent value stock opportunities in UHS, EIX, and SYF, and a cautious crypto market with Bitcoin struggling at 90,000. As always, remember, do your own research and consult with financial advisors before making investment decisions. Thanks for joining us on The Morning Bell. I'm Robert, along with Lizzie and Steve, and we'll see you next time.